This is the Value Investor Podcast with Tracy Reineck. All things value, all the time.
Welcome back, value investors. So I had a whole podcast plan today that I threw out because things are going on out there. And I know many of you have questions on the software stocks, the fintech stocks, basically anything that's kind of techie related that's selling off right now. And a lot of them are these deals, are these values? I've been seeing a lot of people talking on X and other social media sites, on StockTwits, about some of these being trappies, they're traps. And should we, as value investors, be diving into any of this stuff that's going on? Because these are some big sell-offs. We've seen 25 to 40% sell-offs in some of the software names. And these are the stocks I used to call the beasts that I didn't think would see this kind of abrupt sell-off and turnaround going the opposite direction. So as value investors, we always like to snoop around and kind of see what's going on out there. So let's dive right in. Let's just talk about some of these. And I am going to do some of the software stocks because I know you're all interested in those. But I did cover some of these on the Market Edge just a week ago. You can find that on YouTube. Go to Zacks.com/YouTube. Go to our YouTube channel. Find the Market Edge podcast there. And it was just called Software Stocks, Plunge, Deals or Traps, something like that. And I covered a couple of the key ones, including Adobe, Twilio, and I don't remember the other one, but I covered those there. So this time I'm going to cover some more, but also some fintechs and others, because a lot of these are just getting hammered and we want to know, should we be diving in? So the first one is ServiceNow. I did not cover that on the Market Edge. Ticker N as in Nancy, O, W, and they just reported earnings and it hasn't really helped. The shares are still plunging a bit, even though they said AI is not impacting the business, even though they said we're still going to see, this good earnings growth and sales growth expected for 2026, nearly 20% sales growth. And the market hasn't cared. Now, I'm just looking at the detailed estimates to get an idea of what the analysts are doing after that earnings report. And 10 estimates are up for 2026. Only one is down since the report. That's very impressive. The analysts now looking for 412. That's up from 404. So they're not seeing any kind of collapse because of AI taking over their business. But these are the fears that are just kind of racing through the software world that, why do I need ServiceNow's platform if I can just get Gemini and it can have these plugins that do the same thing, and then I don't have to pay to get ServiceNow. These are the fears, but a lot of these companies are saying, no, these fears are overblown. So PE is now at 26 on ServiceNow. That is down pretty dramatically on this sell-off. PEG is at 1.1. So that's looking pretty good. It's almost at the value range. The price to book, price to sales are still really high on any of these stocks because even with this pullback, they were very pricey. Price to book is at 8.8, price to sales is 8.6. So no real value there, but are they deals here? If you are interested in more of the growthy names, the fears about sales slowing is not showing up at all in the estimates, either for sales or the earnings. So there is no trap here. It's maybe a trap of the mind, so to speak. The just irrational fears that take over the street. We've seen this with AI many times. We saw this with DeepSeek. Remember when DeepSeek came out and everybody said, oh, we're not going to need NVIDIA chips now. And NVIDIA slammed down like, I don't remember what it was, 15% or 20% or something in like a day. And then that did not happen, did not pan out. And NVIDIA has gone on its merry way, doubling its revenue. So just a lot of fear. This is a deal if you're looking for software stocks. It's not super value here, but it is a lot cheaper than what it was even just 3 months ago. So ServiceNow is a deal. Let's just call it that. So that's NOW is the ticker. Okay, I wanted to look at AppLovin because this one's getting just hammered. They haven't reported earnings yet, reporting on February 11th. It's down, as I'm recording this on February 4th, it's down almost 16% just today. So 52-week high, $745. It's at $389 now. But not near those 52-week low, which was $200. So still a way to go. So what's going on here? Forward PE is now 30. PEG is at 1.5, but it hasn't reported earnings yet. Let's just see, what are the analysts doing here? Not much. We're waiting on 2025. So only no changes in the last 30 days, either up or down for 2025. And then 2026, one is up in the last 30 days for 2026. So they're still looking at 932 for 2025. That has not changed in the last 2 months. And then 1514 for 2026, 62% jump. And that has not changed in the last 30 days and is up slightly in the last 60. So there's a lot of panic going on here. But so far, the analysts are not panicking. Just the street is panicking. And sometimes you can get deals when you see this kind of panic. And I would call this a deal if all these numbers hold. Those are the big ifs, right? But as of right now, and what the analysts themselves are saying, this is a deal. So it's AppLovin, ticker A, P as in Paul, P as in Paul, APP. And they're reporting next week, February 11th. So we'll be tuning in. Okay, let's switch to fintech. PayPal, everybody's talking about it. I know I've covered it on the Value Investor over the years. It has been cheap many times on a PE basis over the years. They're all talking about it now because it's round tripped. It's gone to new highs in the last 10 years, and now it's touching those 10-year lows, not even just the 5-year, which it's been at for a number of years now since the 2021-22 sell-off, but it is wiped out all those gains. Still market cap of $39 billion with PayPal. Forward PE now is at 7.2. 7.2. So dirt cheap on the PE, PEG of 0.5. So dirt cheap on the PEG. They have reported earnings and they actually did fire their CEO. So they're getting a new CEO in. So that kind of tells you why we're at the 10-year lows, right? But looking at those earnings, which is what we do for this episode, if we're looking for deals, we're looking for traps. The traps would be declining earnings. And here, obviously, something's going to be going on because they're not getting rid of their CEO for nothing. But 2026, so they did come out and report, and we do have one lower in the last week, 7 in the last 30 days, but 2 are higher in the last 30 days. But we're now looking at 575. That is down slightly from 586 just 30 days ago. But it's, not terrible. And it's up from a year ago, which was 531. So that's 8% earnings growth expected for this year on 5.4% sales growth. Now, if this stock was trading at 30 times, like AppLovin is, then I might be like, that's a little too much to be paying for 5% sales growth. But it's not. It's trading at 7.2 times. So it is being thrown out. They're throwing out the baby with the bathwater here. And as it hits these, 5-year or 10-year low scenarios, there are a lot of computer algorithms and things that kick in. You start to see headlines, people who have owned it and maybe been patient start reading these headlines about the 10-year lows and their wealth being wiped out and all this negativity. And they're like, I'm done with it and I'm throwing in the towel too. So that is what we're seeing here as the stock continues to decline. We are seeing people throwing in the towel. Now, 2027, they have 12% earnings growth expected on 5.8% sales growth. We'll see what the new CEO does. That's still a long way off, or $6.45. But shares could still see further sell-off as people just, as I said, throw in the towel, give up on it. And those of us value investors just aren't really willing to get in there and take a chance yet, with a lot of still uncertainty going on in the business. So is this a deal or a trap? It's not a trap based on what earnings are looking like. And it is a deal at 7 times forward earnings. But the shares may go nowhere for, a decent amount of time. So it is a deal. How strong is your stomach? Ask yourself that. But us value investors, we like to dive in when no one else will. And so now is one of those times on a stock like PayPal, ticker PYPL is their ticker. Okay, on that grim news, let's turn to another tech name seeing a sell-off after it has had a great ride. And I'm making no bones about it that this stock is not an actual value stock, but it has gotten cheaper, and it's Palantir, ticker P as in Paul, L as in Larry, T as in Tom, R. I don't think I've ever mentioned Palantir on the Value Investor podcast before, other than to say, hey, it's crazy, don't buy that one. But it is down off of its highs, even after its solid earnings report where it beat and it raised. And it's down, as I'm recording this, another 12%. So its forward PE is still outrageous. It was trading around 200 times not that long ago in 2025. It's down to 151 with a peg of 3. So none of that is cheap, but is this a deal or a trap? Because it is off those highs. And like I said, they beat and they raised. So no, I don't believe the analysts will be cutting here. And we're still expecting to see 38% earnings growth for 2026, 37% for 2027, on 53% revenue growth 2026, 24% in 2027. No estimate changes that we have yet in Zacks, but sometimes it takes a couple of days to get those in. So it's not a trap here, and you are getting it cheaper. But my concern with Palantir has been for quite some time, even though it is executing, is that it's just simply way too expensive. And so these sell-offs are going to happen on these types of stocks, these high growth names, when they just get a little too stretched. So PE of 151 is just too stretched. It's not a deal here yet, even on this weakness, but it's definitely not a trap. So if we get more weakness and a bigger sell-off, then I might be more interested. Price to book is 50. Price to sales ratio, I'm laughing now, is 84. So no, not a value, and no, not a deal either, but it is executing. And so maybe people are just getting a little more realistic that they're not willing to pay 84 times for the sales there. So we like to look at these things because every pullback does create a buying opportunity of some sorts. And it's a deal if you're a growth investor and you really must own Palantir because it is off those highs, but not a trap. So it is still executing. That's Palantir, PLTR. Okay, and then I wanted to look at one stock that people have been saying this doesn't make any sense on the sell-off for this stock. It hasn't reported earnings yet. And I own it in the value investor portfolio here at Zacks, and it's Expedia, ticker EXPE. So its shares have been selling off in 2026. And some of that is on fears that maybe travel might be impacted as the consumer starts to pull back. But we have heard from several of the cruise lines now already that cruise bookings remain robust and near highs. So that's not it. They're still traveling, but still this stock has gotten caught up because it is software, right? You are going on your phone on the app or online to book your vacation. And so everybody is suddenly worried that all of these businesses are going to be AI'd out of business some way. Now, we haven't been seeing that. We've been seeing Expedia and Booking, TripAdvisor using AI tools in their own business to kind of tailor trips and searches to what people want. But we haven't seen, it going away. We haven't seen Gemini taking over for Booking or Expedia at all yet. But Expedia hasn't reported earnings yet, so we're waiting. So the panic is just in. Now, shares year to date are down 17%. And then they have been a little weak even before starting 2026. But I guess just looking over the 3-month period, they're still up 8%. So much of the pullback, I guess, is now more recent in the last month or so, really. But what's going on with these earnings estimates? It is a Zacks number 2 right now. We have one estimate higher for 2025 in the last 30 days and 2 for 2026 because travel really isn't being that impacted. Even the airlines have been reporting pretty solid numbers, especially on those overseas international travel. And Expedia has a lot of that. So it's expected to see $15.19 for 2025. That's up 25.4% year over year. And it's up in the last 30 days from 15.09. So up 10 cents on the estimate. And then next year, looking for 18.33. That is up 21% again next year. And we have those estimates higher, nobody cutting. And that all looks pretty good with a PE of just 12.8 and a PEG of 0.6. So I'm not seeing any trappiness yet on these earnings, but we haven't gotten the report in yet. So that could always change. We don't know. But if it doesn't, then no trappiness. And this looks like a deal here on this sell-off, on this weakness. We're right in the value area on the PE. We got the low peg, and we've got nice double-digit earnings growth expected. So I'm not really sure what's wrong with this story. That's why on some of these, when you hear people say, this doesn't make any sense, especially on the chat boards, on social media, a stock like this really doesn't. We did see a lot of the software companies like LegalZoom sell off when Anthropic rolled out that plugin that could handle like regulatory and legal things on their platform. And so everybody panicked like, oh, I won't need LegalZoom now. But for whatever reason, Expedia and Booking both had big sell-offs on that news for whatever reason. Price to sales is at 2. So that's not a value, but it's not super stretched. Price to book is at 11. So that's not a value either. But everything else is looking pretty cheap with Expedia here. So I still like this story. Almost every quarter, the travel companies have had to come out and say, we're not seeing any pullback. And then the stocks recover off of whatever sell-off they had been in. So that's understandable. People are worried about affordability, and the job market has weakened. That is likely to impact travel, but it just has not so far. So Expedia, not real pricey here. I would be more worried if this was trading at 20 times on a PE basis and its PEG wasn't that low. Then I might be like, well, this isn't that cheap, but it's still a value here. So I'm liking it, and I do think that this is a deal even ahead of earnings here. So we've had a lot of deals on this. Did we have any that were traps? Maybe only PayPal. But it's not even really a trap based on earnings. No. So none of these are traps. It's just kind of panic, emotional selling based on worries about AI and how it's going to change a lot of businesses and our society and culture, basically. So the hardest thing in investing, as Warren Buffett will always tell you, is to keep your emotions in check. That's what makes him the world's greatest value investor, or just investor overall. He's able to tune out the noise, and we are trying and doing our best to do the same thing and learn that skill. And it helps to look at the actual charts, to listen in on these conference calls, to hear the CEOs themselves say, no, we are not seeing a business slowdown because of AI. Not right now, not in February 2026. Of course, everything, things can change on a moment's notice in any kind of business. But from what they know and the information they have, it's just more of an emotional sell-off here in a lot of these. Now, a lot of names have been stretched and were not values. So it's not a surprise to see some of those retreat. But some of these are value stocks already, and they're retreating further. So keep these names on your watch list. And for some of them, like Palantir, maybe we're going to get even a bigger pullback that might make it attractive even for those of us who are true value investors, and we want to get that valuation much, much lower, because that's where the secret spot is to get value stocks still growing those earnings, like Expedia growing double digits this year after, great earnings growth last year. So let me recap the stock tickers again. We had ServiceNow, NOW. It's not a value, but it is much cheaper, so it's a deal. We had AppLovin. It's not a value either, based just on the fundamentals, value fundamentals, PEs and the like, but it is much cheaper. AppLovin, APP is the ticker there. It's a deal. Then we had Palantir. Let's cover that one. PLTR. Still just a crazy growth stock, but it is cheaper than just even a couple of weeks ago. So it is a deal if you're a growth investor. Then PayPal, it's dirt cheap across the board. It's at 10-year lows, but those estimates for now are still showing earnings growth this year and next year, even though they've come down a little bit, but a lot of uncertainty there with new management and the like. So it is a deal, but you got to have strong stomach to dive in when no one else is diving in. And then we had Expedia, cheap as a value stock, earnings expected to be up and showing that nice double-digit growth. And so it's a deal here, but we're waiting on earnings. We're waiting on earnings with some of these. So be sure to tune in on earnings for that one. EXPE is the ticker there. So again, these are interesting times for those of us who are value investors. And who knows, maybe next week I will have to throw out my episode again and cover some more of these stocks as they get even cheaper. We are going to get a lot of earnings reports in this week and next week. About a quarter of the S&P 500 is reporting. And so we're going to see a lot of guidance and estimate changes going on. And if this pullback in the overall markets continues, and especially in these tech names, then maybe we will find even more deals. So be sure to tune in, get the podcast. I know many of you are. We are on Spotify. We are on Amazon Music. We are on Apple, of course. And we are on YouTube as an audio podcast on our special YouTube channel just for podcasts. And you can find it under Zach's Podcasts. But be sure to get us somewhere. Be sure to subscribe. Click the like button, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.